Hello and welcome everyone to another episode of Engineering and Investment. Today we're going to look at some high quality companies that stocks could be overvalued. So I want to look at Costco to start today. Costco, for those who don't know, which I don't know how you wouldn't, is the wholesale company that the wholesaler for like big box items like grocery store, and they sell everything at Costco now, but basically you pay a membership premium and then you can shop there and buy their selection of goods. And so we're going to go back to handy dandy fast graphs here, and we're going to look at, we got this black line, that's the price. This blue line is the normal average price to earnings ratio that this company normally trades at, and then this orange line is what would be fair value based on their growth rate. So which for Costco, growing at it's less than 15% per year, is going to be at a 15 price to earnings. As we can see, Costco is a very solid company that's grown earnings almost every year. The earnings graph, if we take off the price and take off the normal PE, this is exactly the kind of earnings chart you want to look at, up and to the right. So it's been beautifully growing earnings. So it's a very high quality company. Shout out to them for their dollar hot dog meal combo and all that. The main competitors that they're going to be facing off against is their main comparison would be Walmart or Sam's Club, particularly Sam's Club, which is owned by Walmart. And so, I mean, this is the exact kind of chart you want to see. But if we look at normal PE, it's always traded at a premium to what its earnings do. And then if we look at the price, we can see that it is just skyrocketed and gone way above what it even normally trades at. So if we go to look at forecasting, what this looks like for us, yeah, it's currently trading at 47 times PE, and even if it continued to trade at a 47 PE, you're only looking at an annual return of approximately 11% based on its earnings growth. So you have to get that 11% return, you basically have to hope that it keeps trading at a 47 PE, so you don't get any multiple compression, and it meets its earnings. I don't think it meeting its earnings is going to be that big of a question, but this is definitely at risk of seeing a multiple compression. If we go look at, there's 33 to 35 analysts providing their numbers for this. So, and I would imagine that it's not that volatile of earnings predictor. So the analyst shouldn't have that difficult of a time. Currently it pays a very small dividend, 0.62%. I would guess that's because it's trading at such a high valuation that drives the yield way down. So if we look at how the analysts are able to predict this stock, Costco has a habit of beating in the short run and hitting right on what the analysts project in the long run. Like I was saying, it seems like a pretty easy company for analysts to be able to model and put in their spreadsheets and churn out some decent projections. Like I said, this is a very high quality company, but its stock has just run way past what a reasonable valuation would be. I say invest with caution on this one, because if we have reversion to the mean on this, we could be looking at, if we go to forecasting again, we could be looking at massive loss of return. of like 33% per year if it goes down to a normal fair value of 15 price to earnings. But even if it goes back to just what it trades at on average, if we go to 10-year average, you would basically, if you're buying now, you're going to be flat in a few years if we get multiple compression. And that's still a high multiple, 37 for basically a grocery chain. That is a quite the premium to pay. I want to say though, Costco has become a cult-like following. I wouldn't bet against them just because there's so many people. It's become a cultural sensation. I can see why there's a premium, but the share price is way above the earnings line at this point. So on that same vein, let's talk about one of their biggest competitors, Walmart. And here we see an even worse picture. Walmart's price has way outrun its growth rate and way outrun its normal value. Walmart is a high quality company, and we've seen it gain market share in the higher income customers. They've been saying that in their earnings reports that they've been gaining market share in groceries and higher income and been taking it from Target. So let's just remove price and we can remove the normal, and we see earnings. It looks pretty cyclical here. We got it drops down in 17, but for the most part it's up and to the right. If we go back, put price on it, we see that the price has way overrun its growth rate and its fair value. It's even overrun its normal value. We can look at some projections and look at the forecasting tab. So it's currently trading at a 40 multiple, and even if it continues to trade at the same multiple, you're still only looking at like 11% return year over year. So about the same as Costco. It has pretty similar numbers across the board here on the growth rate too. It's just Walmart compared to Costco. I think you're looking at two different consumers who's going to be going to either of those, and just for sheer, and they're trading at pretty similar multiples, but just from sheer cult following, I think Costco would be the safer option. But still, you're looking at Walmart does give a bigger dividend, but that's probably because they're just slightly lower multiple. If we look at, so they've been beating on the short term, and the analysts can generally predict 1 year in the future. So they've been doing better than expected. They're $890 billion company, so they're almost cresting the $1 trillion club. But if you just sit back and take this in for a moment and look at, wow, the share price has gone way above the earnings line. If we want to look at maybe some other metrics of what to look at, maybe we check operating free cash flow. As we can see, it's generally traded below its operating free cash flow until recently. It's just skyrocketed above that. We should probably look at that for Costco as well. Generally, earnings is, so yeah, it's the same. It's still the same picture. It's not exactly. It didn't paint it in any better light. Costco and Walmart are both massively overvalued. These are high quality companies that what you're paying for is not giving you good value for what you're getting in terms of share price. If you're paying 40 times earnings and it's only growing at 10%, you're you're going to be waiting for to get your money back for a long time. With, with that being said, let's check out another high quality company that stock is way out of whack. So Waste Management, I'm sure everybody knows, is the trash truck. The green trash truck that comes around and picks up everybody's garbage and takes it to the dump. They have a lot of different business lines, but as we can see, this black line is so far above even the normal multiple line that it's hard to imagine it being that we don't see a reversion to the mean eventually, because this is just an obscene valuation for a company that really isn't going to be growing at a crazy rate. So 29 current PE, whereas earnings, I mean, they're good, but they're not like fantastic. So even if they continue to trade at this rate, you're looking at total annual return of 12% year over year, which is pretty good. Like the companies we've looked at, Walmart, Costco, Waste Management, they all have about, if they keep trading at the earnings growth rate that they're currently trading at, you could see a nice, like that's a pretty decent return. But the risk you're taking is you could drop, you get any bit of multiple compression, and all of a sudden your nice comfy 12% drops to a negative return. And like they have a nice sticky business model because it's hard to they have a big moat. It's hard to get competition in there. They pay a nice dividend. This is a high quality company. You're just paying a lot for this high quality company. In the short term, the analysts aren't as good at projecting, but long term, they're usually dead on. So what we can see with what that means for us is that these numbers are generally pretty good. So now there can always be surprises, and the past performance doesn't predict future performance or doesn't guarantee it, but it's all we have to go on. So if we go back to the historical looking graph, maybe one day it'll click, but alright. I mean, it's not impossible for this stock to go down if we see and trade at near fair value. Trying to drag this slider bar here to go back in time, but if we look over here, I mean, we have times where it's trading at its orange bar multiple times throughout the course. It wasn't until like 2012 when it just completely decoupled from its earnings line and just has gone absolutely bonkers, way up past where fair value would be, and even what the premium for being Waste Management would be. So and I guess my point with these companies is these are really quality companies that I would be looking to, that I would put on my watch list, and if I ever see them, my first trigger would be if I see them drop to what the blue line would be, and if they drop to what the orange line would be, then I know I'm getting a really great deal for a really high quality company. If they ever fall below this orange line, then at that point I would want to be in position to maybe buy some. But at its current valuation, I don't think that's really a good idea. So we talked about this in my first live stream, Curtiss-Wright Corp. This is another really solid company. They make like valves, pumps, different industrial equipment for industrial stuff. So in my line of work, I see a lot. They're a vendor for a lot of our pieces of equipment. I get a lot of drawings with their name stamped at the bottom. So this company is a very high quality company. If we take the price and the normal PE off, we just see it's just up and to the right. Like, this is a beautiful, it's a little bit cyclical. See, we got a dip here. There's a dip in 2020, but who didn't dip in 2020? So this is a really good company. And if we look at the normal multiple, it's not like it's traded at a huge premium over time, but until recently, it's just gone crazy. So if you bought it, if you continue to pay 50 times earnings and you just held it, and as long as the multiple stayed the same at the current Earth growth rates, like 13% year over year, that's a pretty good return on your investment. Not anything crazy, but that's a good return. Like, that's solid. But you're taking so much risk because you could get some multiple compression, and even if the earnings stay the same, but your multiple compression goes down, you're looking at massive losses of capital. Just sheerly from the market pricing their earnings differently. And because the prices run up so much, their dividend is only 0.14% yield. That is a crazy. That's a very small dividend. So this is another high quality company. I talked about them my first week. That if we ever see a big retracement like this, for this to even come down to the blue line, a massive reversion to the mean, I would be all over this company. This is just because in my line of work, I see so much of their stuff, and I'm very familiar with this company, and they have the exactly kind of graph you want to see in terms of earnings. It's just what you're getting, the price you're paying for a share of this company is astronomical compared to the return on investment that you would need to get at the multiple it's trading at. So that's the theme of this broadcast this week. So, and then now I'm going to move on to requested. I got some requests for companies to look at. So I'm going to check. This is automatic data processing, and so this is a company that I don't even know what they do. So maybe Google's Gemini can tell us. But I don't know why I try to click off of things. My computer's working really hard with the live stream going. So automate. So if you guys have recommendations for companies for me to look at, you can leave them in the comment section, and I would love to check out comments and look at stocks that are on your guys' minds, and I'll give you my thoughts on any company you want me to take a look at. So they're paying a decent. I'll do my first impressions, what I normally do researching any stock. First impressions, I'm going to take off the price and the normal PE. This is the exact kind of, this is a nice looking chart up and to the right pretty much throughout. So if we put these back on it, it's always traded at a premium. It's a premium multiple. Not always, because it's traded down here below that, but its premium multiple is higher than the orange line. So it's tracked this blue line pretty well until 2020 it dipped, and then again now in 2026 it's fallen again. And this is the kind of thing I was talking about with like Costco and Walmart, where it's a really high quality company, but then you see a nice mean reversion back down close below the blue line, getting close to the orange line. This is when I would start looking to be accumulating, and so and we see we got a bounce off here, so it looks similar to this time period, perhaps this time period down here. We can take a look at forecasting. If we forecast this out, if it keeps trading at the same multiple, which is about a 21, maybe a 22.5, then you're looking at 14%, maybe between 10 and 14%, so low double digits, which is solid return. Solid return. So they're $96 billion market cap. I want to find out what this company does. The analysts are smack right on. They're very good at projecting, so this seems like a nice company. You can just, they put in their spreadsheet and it calculates it out. And so we see, if we look at our returns, we got 9%, 10%, 10%, 9%, and we got almost a 3% dividend. So that's where we get the low double-digit return. Pretty much 10% from earnings and 3% from dividend, and that's generally how you find your return. You get cash returned to you as an investor through a dividend, or the company's earnings grow. So let's do a little Googling. Automatic data processing. Let's find out what this company does. Cloud-based human resources management, payroll processing, and professional employer organization. So it sounds like they got sold off in the software sell-off, and they are rebounding. So they're a HR and payroll software. Gosh, Google. I don't know if this is Google, but these search results are. So you get ads, more ads. So okay, so that makes a lot of sense why projections are so good and why they always trade at a multiple. Software companies trade at a multiple because it's really easy for analysts to project. You got, okay, I'm gonna increase my prices this much year over year. I'm gonna grow my subscribers this much year over year. Bing bang boom. It's pretty easy to approximate. It's software as a service, subscriptions. This is the price of a seat. So here, everything's going up, and then all of a sudden, every software company took a dive when the fears around AI came out. So I think we've seen this rebound in pretty much every software company since very recently. It's kind of marking the bottom since the fear. I mean, that's potentially not the bottom. We could see another drop, but at least a local bottom. So from there, I would say this is a high quality company. The time to be buying was a little bit behind us, but even if you bought now, you could look at solid, respectable gains with some risk attached to what is AI going to do to the industry and perhaps multiple compression at some point. But just from the sheer fact that it's always traded at such a premium, that this would be a solid low double-digit returner. It looks like. So if you're looking for some software to catch in the rebound, this is a good company to look at. So another company I want to check out, I guess we could another company we can look at this is another software company, Adobe. This is one that's been absolutely killed by the software sell-off. Is massive downtrend. Everybody knows what Adobe is. They got I know them as the PDF people, but I think they have other business segments. And I was telling you guys in my first live stream that even my job has switched off of Adobe for PDF, and they've gone with this company called Tungsten PDF, which I've never even heard of. And frankly, maybe it's just because I'm used to Adobe, or I don't know if the tungsten is actually bad, or it's just that much different than Adobe that I don't like it. But this Adobe's got a beautiful looking earnings graph, and it's always traded at a very high premium. And we see currently that it's just getting crushed. So forecasting wise, I mean they have stronger earnings projections than a lot of the companies we've even looked at recently. So if it gets back to a 15 PE, you'd get 36% year over year. I think with this, when you gotta look at Adobe, you're gonna be taking the risk on. I don't think you're gonna go back to a 15 PE. If it comes back, I think you're gonna go back to the premium valuation that you would be getting. But if it doesn't come back and the AI headwinds are real, then you're looking at these numbers coming down and you're not getting the return that you thought you were gonna get. They don't pay a dividend. So the analysts, again, they're very good at predicting and beating what the analysts say. So at this point, if you're buying Adobe, you're buying that the risk is way overblown, and the rumors of their death have been greatly exaggerated, is basically what you're buying with Adobe. So this is another high quality company, but this one would be a turnaround story and not a high quality company that's share price is overrun. If we want to take a look at another company in which let's see. This was another recommendation from, this one came from a coworker. They wanted to see what AutoZone looked like. So, AutoZone looks like another high quality company. So, a nice up and to the right graph. I'll put the price back up there. The normal PE, it doesn't really trade at a premium. Its blue line is right on its orange line. And this is what you always worry about with reversion to the mean, with like a Costco, like the graphs we see with Costco and Walmart now, is nothing changed in terms of earnings from this point to this point, but you still get a massive drawdown, which would be like 28% year over year. So you would be, if you bought up at this peak, and you just get multiple compression and it just comes down, you could be seeing a massive correction in your share price and losing a lot of money. So this kind of chart would be the fear with a Costco, a Curtiss-Wright, a Walmart. So if we look at the forecasting, so they're not really they got a slow current year, they got a pretty slow the next year, but then it's expected to pick up after that. And so if it goes down to its 15 PE, you're going to be losing money. So this company is still overvalued, even with the normal premium because this company doesn't really get a normal premium put on it. So it's not really you're looking for multiple expansion on this one. So this one would still be a questionable one. I mean, this one's still off my radar, honestly. I honestly stay away from all things auto, just because auto is so cyclical and not really my cup of tea. So anything associated with that. There's another company I want to look at that I haven't looked at in a while. I used to think their graph looked pretty good. So we have this is Cheesecake Factory, the restaurant chain, and I was looking at it. Well, so we had their earnings crater in 2020 when they closed all the restaurants. And I was looking at it back in this time. I didn't actually buy any, but I was like, oh, their share price is below their graph, and they got a lot of growth coming. So it looks like I missed the boat, because they've gone to the moon and back. Not even back, not and back, but they've gone to the moon essentially from when I was looking at them. So black line is below the orange line, and as their earnings grew, their share price really grew. At this point, I would be saying this is too overvalued. I'm not really looking to buy. Cheesecake Factory would be the one restaurant I would look to own, just because if we go out to eat, we're going to Cheesecake Factory. That's just the truth of the matter. Is we love their food, we love the cheesecake. It's the thing about having a dessert as the main place you go is seen as like the namesake of your restaurant. But so if anybody's going to Cheesecake Factory, if they go for dinner, they gotta buy dinner, but then they're at Cheesecake Factory, so they have to get cheesecake. But if you go to the Cheesecake Factory and you're not looking for a meal, like, what time are you going to Cheesecake Factory? Because I feel like you're going to a restaurant, you're going for a meal, right? Who's going to go to a restaurant and not get a meal? So with that, you're getting extra purchases, and the bill is going up every single time because everyone's buying cheesecake after they already bought a meal. Whereas, like, you go to a regular, different restaurant and you buy your meal, but you're like so-so on dessert, but you're for sure gonna buy a cheesecake from Cheesecake Factory. That is just, you have to. It's basically the law at that point. So I think that, to me, that adds to why they would be such a good business, is you're getting the guaranteed dessert purchase on a dinner. And that's invaluable in restaurants. So at this current valuation, it's just too much. Like, you're not gonna get you're not gonna get good value for what you're paying for it. There's this saying I heard: the only way to become a millionaire in the restaurant business is if you started as a billionaire. I think that's probably true for every restaurant but Cheesecake Factory, just because their cheesecake is that good. You got the guaranteed dessert purchase. Great company, overvalued stock. With that being said, I want to remind everybody to make sure you like the video, leave recommendations in the chat or in the comments. I'd love to take a look at some of the companies that you guys are talking about and thinking about investing in, and give you guys my opinions. Or if you think there's some really funny looking graphs you want me to look at, I'd love to check those out. If you guys want me to do some follow-ups on some of the companies I've covered, and check out more in depth of what they've done, what do they do as a business, and what does their fast graph look like now after the recent price action, or if they just had an earnings report. I'll go back and follow up on some of those companies. Yeah, like, subscribe, tell your friends, bring in a few more viewers. Yeah, I think this is a worthwhile endeavor, and so with that, I'll be closing out.